Welcome back, everyone. Thank you so much for being here. Thank you for joining. If you're new, please make sure you're subscribed to Newsix Brief. It just takes a second. 4 months now, the official story we've heard in Washington has been that the United States economy is holding up just fine. In fact, we hear that the US economy is the strongest it's ever been. You'll see numbers like nobody's ever seen before. The economy is doing amazingly well. I wish the press would report it, but people are finding out. They're seeing it. It's coming. It's becoming pretty evident. It's hard to hide. Consumers are resilient, they tell you. Jobs are plentiful. And growth may be slowing, but there's no real reason for you to worry. And yet, when you look at the data, which we're about to do in this video, it tells a very different story. What you notice when you look at the details is rising financial stress, growing uncertainty, and an economy that's very clearly losing momentum. It is losing steam. So let's start with the consumer, the backbone of the US economy, because that's where the cracks are becoming impossible to ignore. On Friday, February 6th, Federal Reserve data showed that in December, US consumer borrowing surged by the most in over a year. In other words, Americans are maxing out their credit cards. They're maxing out their lines of credit just to make ends meet. That's it. That's what's happening. And that's a very sad reality we're living in. Fed data showed that total consumer credit outstanding jumped by $24 billion, a massive acceleration from the modest $4.7 billion increase the month before. So we're talking about month-over-month fluctuation, $24 billion added in consumer credit. This was not, of course, just higher than expected. It actually blew past every single estimate, every single forecast. And importantly, this wasn't driven by one-off spending. Both revolving and non-revolving credit rose sharply at the same time. This is not a coincidence. It's very important to note here that these numbers do not include mortgages. So no long-term borrowing is included in these numbers. Non-revolving credit, things like auto loans and student loans, increased by just over $10 billion. This is the biggest rise in 7 months. That alone should raise eyebrows. But the real red flag, if that wasn't enough, is what happened with revolving credit. Credit card balances jumped nearly $14 billion in a single month, the largest monthly increase in more than 2 years. Remember, this data doesn't include mortgages. This is day-to-day living financed at interest rates north of 20%. Is this sustainable? Absolutely not. This cannot go on for a long time. Someone has to pay back this debt. And unlike the US government, Americans are on the hook for their credit card balances. They must pay back their borrowing. And if they don't, what happens? Defaults rise. I hate to be pessimistic here, but I do expect to see a rise in defaults later this year. Why do I expect that? Well, I actually have bad news for you, and I discussed this in great detail in my video that I uploaded yesterday. The labor market is crashing. January showed a 205% increase in US layoffs compared to December. Month over month, a 205% increase in layoffs. Just think about that, and we'll get to that in just a moment. Maxing out credit cards is not the behavior of a confident consumer. It is the behavior of households that are effectively filling the gap between stagnant income and rising costs with debt. That's what's happening. And that's where the timing becomes critical, in my opinion, because this explosion in borrowing is happening just as the labor market is starting to weaken considerably. In January, US employers announced 108,435 layoffs. That's not a typo. That's not an error. Layoff announcements were up more than 200% from December, from a month prior, and a 118% increase compared to January a year earlier. Even more striking, this was the highest number of job cuts announced in any January since 2009, right in the depth of the Great Recession. Now, layoffs do tend to cluster early in the year. It's true. And you may say, well, it's January. That's not that unusual. This happens because companies clean house, they restructure, they reset their budgets. And that is normal. But this January was not normal. Not even close. And here's why. According to Challenger, Gray, and Christmas, the firm that tracks this data, most of these layoff plans were finalized at the end of last year. That means companies entered 2026 already expecting weaker growth, softer demand, and tighter margins. In other words, corporate pessimism didn't suddenly appear this month, in January. It was baked in months ago. And here's where things get truly concerning, in my personal view. At the same time that layoffs surged, hiring intentions collapsed. In January, companies announced plans to hire just over 5,300 workers nationwide. No, this wasn't just in one city or in one state. 5,300 workers nationwide. This is the lowest number ever recorded for the month since Challenger, Gray and Christmas began tracking hiring plans in 2009. This was lower than during COVID, lower than during past recessions. Absolutely unprecedented. When layoffs rise and hiring plans dry up simultaneously, as they do now, that is not routine belt tightening. That's not just cutting costs. That is a warning signal. There's more to come, and it will be worse. What's worse is that inflation is expected to rise this year. So some would argue that it might begin to look a lot like stagflation. This fits into a broader pattern that's been developing for more than a year. The so-called low-hire, low-fire labor market. Layoffs haven't exploded across every single sector. You may have noticed this, but hiring has slowed to a crawl. Job openings have been drifting lower and lower every single month. Workers are finding fewer opportunities to switch jobs, to negotiate better pay, to negotiate higher pay, or to climb that corporate ladder. There are just fewer opportunities for them. And stagnation is brutal for households. Economists often describe job openings as a forward-looking indicator, and that's why it's such an important thing to keep in mind. Job openings tell you what employers plan to do in the near future, not what they've already done. And so when openings decline, it's a signal of hesitation. It signals uncertainty. It signals that businesses don't trust the future enough to commit to hiring individuals, to commit to growth. They're not looking to expand. They're just looking to survive, in other words. And that uncertainty is everywhere right now, and I'm sure many of you can relate. Let me know in the comments below what you see in your areas, what you see in your states. I would love to hear from you. So consumers are borrowing more, not because they're optimistic, but because they're trying to maintain their standard of living. Credit cards are becoming a substitute for wage growth. At the same time, companies are freezing hiring, cutting costs, and preparing for leaner times ahead. This is preparation. And this combination is especially dangerous. Rising consumer debt can temporarily prop up spending, and that's where you see consumer demand is strong. But it comes at a cost. As interest expenses climb, households have less room to maneuver. And any shock, such as a job loss, reduced hours, maybe a medical bill, those things can quickly turn manageable debt into a complete crisis. And remember, these layoffs are announcements, not yet reflected fully in the official unemployment rate. That's why the surface data still looks okay. And so Washington is able to manipulate it enough to tell you that everything is good. But the real damage often shows up with a lag. This is how an economic downturn begins, not with a dramatic collapse, but with very subtle shifts. And we certainly see many of those subtle shifts right now. We see fewer job openings, fewer hires, more reliance on debt, more anxiety behind the scenes. The narrative we are being sold is that the economy is resilient. But resilience financed by credit cards and met with corporate pessimism is not strength. It is fragility. It's extreme vulnerability. The key takeaway here is simple but extremely uncomfortable, and I'm sorry to say this. Consumers are stretching, companies are retreating, and the labor market is losing its forward momentum. That's not a recipe for sustained growth. This is a warning that the foundation is weakening, is cracking, even if the headline numbers haven't caught up just yet. And once confidence breaks, once layoffs move from announcements to reality, and once debt stops bridging that gap for households, the adjustment can happen very, very quickly. And of course, here I'm talking about those defaults. This is the moment to pay attention, not to the optimism in press releases or White House statements, but to the signals underneath, because they're telling us something very, very important. And I hate to admit, this is not good news. If you'd like to learn more details on the surging layoffs and the crashing labor market in the United States, I just uploaded a video on that yesterday. You're welcome to watch it next. Now, let me expand on what this really means for the average American household and why understanding these debt dynamics is essential for navigating what's coming next. Because what we're witnessing isn't just an economic slowdown. It's a fundamental breaking point in how Americans have been maintaining their standard of living for the past several years. The first thing to understand is that consumer debt doesn't exist in isolation. It's a symptom of a much deeper structural problem: wage stagnation coupled with cost of living increases. For decades now, real wage growth, meaning wages adjusted for inflation, has been essentially flat for the median American worker. Meanwhile, the cost of housing, healthcare, education, and basic necessities has climbed relentlessly. This gap between what people earn and what they need to spend has been widening for years. And for a long time, Americans bridged that gap in various ways. During the housing boom, they used home equity. During periods of low interest rates, they refinanced and borrowed. When student loan payments were paused during COVID, that freed up cash flow. But all of these temporary relief valves are now closing. What we're seeing in this $24 billion surge in consumer credit is the desperation phase. This isn't people splurging on luxuries. This isn't discretionary spending run amok. This is people using 20% plus interest rate credit cards to buy groceries, pay utilities, cover rent, handle car repairs. The basic expenses of daily life. And here's what makes this particularly insidious. Once you start relying on credit cards for necessities, you enter a debt trap that's incredibly difficult to escape. You're not just paying for this month's expenses. You're also paying interest on last month's, and the month before that, and the month before that. The minimum payments creep up. The available credit shrinks. And you're running faster and faster just to stay in the same place. This is why the timing matters so much. If this surge in borrowing were happening during a period of strong job growth and rising wages, it might be sustainable. People could work more hours, get raises, switch to higher-paying jobs, and gradually pay down the debt. But that's not the environment we're in. Instead, we're entering a period where job opportunities are contracting. Companies aren't just slowing hiring, they're actively cutting positions. And this isn't happening in one sector or one region. It's broad-based. Technology companies, retail, manufacturing, finance. Layoffs are spreading across the entire economy. The announcement of 108,435 layoffs in January is staggering, but the real number is almost certainly higher. Not all companies announce layoffs publicly. Many restructure quietly. Many use attrition, just not replacing people who leave. Many reduce hours or shift workers from full-time to part-time. None of that shows up in the challenger data, but it all has the same effect. Less income, less job security, more financial stress. And when you combine rising debt with falling employment security, you create a catastrophic feedback loop. People lose their jobs or have hours cut. They can't make credit card payments. They default. Their credit scores tank. They can't borrow even in emergencies. They fall further behind on other bills. Evictions and foreclosures start. Consumer spending collapses. Companies see revenue drop. They lay off more workers. And the cycle accelerates. This is exactly what happened in 2008 to 2009, except that crisis was triggered by housing. This time, it's being triggered by consumer credit and employment simultaneously. And in some ways, that's more dangerous because there's less collateral involved. When someone defaults on a mortgage, the bank can foreclose and recover some value from the house. When someone defaults on credit card debt, there's nothing to seize. The losses are nearly total. This is why I expect defaults to surge later this year. Not because I'm pessimistic by nature, but because the math doesn't work. You cannot have record-high consumer debt, record-low hiring intentions, and surging layoffs without triggering a wave of defaults. It's mathematically inevitable. And when those defaults hit, they won't just affect individuals. They'll impact the entire financial system. Banks that have extended all this credit will see their loan portfolios deteriorate. They'll tighten lending standards. They'll reduce credit limits. They'll increase interest rates, all of which makes the problem worse for consumers who are already struggling. Meanwhile, the official unemployment rate still looks relatively benign. It's under 4%, which by historical standards is quite low. But this is where you need to understand the lag effect. Unemployment is a lagging indicator. It tells you what already happened, not what's about to happen. Job openings, hiring intentions, layoff announcements, these are leading indicators. They tell you what's coming. And right now, they're all flashing red. The unemployment rate will catch up eventually. It always does. But by the time it does, the damage will already be done. This is also why the narrative from Washington is so disconnected from reality. Politicians and policymakers are looking at lagging indicators. Unemployment rate, GDP growth, stock market levels, and declaring victory. But people living paycheck to paycheck, watching their credit card balances climb, seeing job openings disappear, hearing about layoffs at their company, they know the truth. The economy isn't resilient. It's running on fumes. And those fumes are consumer debt at usurious interest rates. What makes this particularly frustrating is that this didn't have to happen. If wage growth had kept pace with productivity, if housing costs hadn't spiraled out of control, if healthcare weren't absurdly expensive, if education didn't require massive debt, if companies hadn't spent decades prioritizing shareholder returns over employee compensation, if the tax code weren't tilted so heavily toward capital over labor, if any or all of these structural issues had been addressed, we wouldn't be in this position. But they weren't addressed. And now we're at the breaking point. So what should individuals do? First, if you have consumer debt, particularly high-interest credit card debt, paying it down needs to be a top priority. I know that's easier said than done, but every dollar you can throw at that balance is a dollar you're not paying 20% plus interest on. Second, if you're employed, this is not the time to assume your job is secure. Build an emergency fund if you can. Cut discretionary spending. Prepare for the possibility that hours might get cut or that you might need to find new employment. Third, if you're looking for work, understand that the market is getting tighter. It's going to take longer. There will be more competition. You may need to be more flexible on salary, location, or job type. Fourth, pay attention to the signals, not the headlines. Don't let political rhetoric or optimistic press releases lull you into complacency. The data is clear. The trajectory is clear. We're heading into a period of economic stress, and being prepared is far better than being surprised. The uncomfortable reality is that millions of Americans are one unexpected expense away from financial crisis. The buffer that consumer credit has provided is running out. And when it does, the adjustment is going to be painful, not just for individuals, but for the entire economy. This is the moment to prepare, to be realistic, and to understand that the resilience we keep hearing about isn't real strength. It's borrowed time. Thank you very much for watching Nuzik's Brief. I appreciate your time, and thank you so much for being here. I hope you enjoy the rest of your day, and I'll see you back here in the next video. Bye for now.